I will go through the information, guys. Please, when I'm writing the information, I want us to pay attention to that so that we don't miss anything that is important that we will be doing. So this is our question. Example 1, we've required, and then we have the information that is provided to us up until the end. So we're going to go through that, and then we start working on the cash flow statement. The information given was taken from the accounting records of Backstreet Limited for the year ended 28 February 2014. So this is our financial year end, 28 February 2014. When is it starting there? If it ends 28 February 2014, when is it starting?
1st of March 2013.
1 March 2013. Thank you on that. 1 March 2013 is the beginning of our financial year, and it ends 28 February 2014. Okay, this is our accounting period. What is required? So this is what they want us to do. Use the information given to prepare the following notes to the cash flow statement in respect of cash generated from operations. So this is the first one they want us to do. They want us to do cash and cash equivalents. They want us to do dividends paid. They want us to do taxation paid, and they want us to do fixed asset purchased. So these are the notes that they want us to do. Out of all these notes, guys, I'm just going to highlight this one. This is the most important note in the cash flow statements. The other ones, they are not important because it's not necessary for us to do all these notes. The only thing we can do, when we should be able to do the calculations that are required. But today we're going to do these notes. But going forward, we will not be focusing on them more, but we will be focusing on things that will be asked in the exam. These notes, I'm not saying they are important, but they will not be asking you these notes in the exam. They want you to do the calculation. So for us to calculate dividends paid, we must use a T account, which is a general ledger account. Income tax paid, I want us to use a general ledger account. Fixed assets, I want us to use general ledger account instead of the notes. General ledger account is more effective. Okay. Number 2, prepare the cash flow statement for the year ended 28 February 2014. So we're doing the notes, then after that, we prepare the full cash flow statement. So this is the information provided to us. Extract from the income statement for the year ended 28 February 2014. So this is the information that is sitting in the income statement. They gave us the net profit before tax, they gave us income tax, and they gave us net profit after tax. Okay, then they gave us a note here. The following expenses appeared in the income statement. We have a depreciation on equipment that is sitting in the income statement, which means these amounts are included in net profit before tax. Depreciation on vehicles, 36,000, and then interest on loan, 14,400 rands. Okay, and we have summary from the balance sheet as at 28 February 2014 and 28 February 2013. So this is the current financial year. This is the previous financial year. Land and buildings at cost, 1,750,000. Equipment at carrying value, 148,000, 184,000 in the previous year. Vehicles at carrying value, we have 373,000, 275,000. We have fixed deposit, London Bank. We have inventories. We have trade and other receivables. We have bank. We have petty cash. We have ordinary share capital. We have retained income. They say we must see note number 2. We have mortgage loan from London Bank, and then we have trade and other payables. We must see note number 3. So these things are very important. When they're saying see note 1, which means in note 1, there is something that affects equipment that we need to look at. See note 1, which means there's something that affects vehicles that we need to look at there. And then here, a retained income, they gave us retained income, but we must look at note number 2, which is giving us information on there, which is giving us information about retained income. And then we must see note number 3 for trade and other payables. Okay, and then it gave us the amount here. Number 3, notes to the balance sheet. They gave us note 1 that we should be aware of, and then they gave us note 2 and they gave us note 3. So these are the things they were talking about there on top that we should be looking at when we start answering the question. Equipment was sold for cash at its carrying value of 16,000 rands. During the financial year, no equipment was purchased. We can see now that there is an equipment that was sold for 16,000 rands. So this is a cash flow. This is a cash movement because we sold it for cash, which means we received money into our bank account, which is 16,000 rand. So this is a cash flow movement. It has to go to our cash flow statement. A new vehicle was purchased for cash during the financial year. We don't know how much, which means we need to calculate how much we purchased this thing. Remember, when we're doing cash flow statement, we're focusing more on the movement of cash. Additions were completed during the to the premises for cash during the financial year. So this is affecting what? The London buildings. So we need to look at that. Distributable reserves, we have balance on 1 March 565,000. This is note number 2. Net profit after tax, we have dividends for 40, and then we have balance on 28 February, which is 1,175,000. This is note number 2 they spoke about here when they said we must look at this 1,175,000. That is for it's for retained income. Actually, they call it distributable reserves. This is another word they can use, but this is actually a retained income. Note number 3, trade and other payables consist of trade creditors, accrued expenses, SARS income tax, shoulders for dividends. In a note like this, the reason why they're breaking this down is because they want us to exclude these two, because these two, we calculate them separately. They're not part of trade and other payables when it comes to the cash flow statement. So what happens is we usually do the calculation separately. This one is for tax paid. This one is for dividends paid. And then the traded creditors and accrued expenses, they will be in the trade and other payables, which is the changes in working capital. So this is the information, guys, that is in front of us. This is the information that we need to start working on. Okay, let me go to my Excel. So here you can see here I have what I have. You can see here I'm going to have a cash flow statement, and then you can see here I'm going to have what? The note to the financial statements, which is a reconciliation between the net profit before tax and cash generated from operations. For now, I want us to start with note number 1 first. I want us to start with note number 1 first, so that we can see what if we can do it. Note number 1, you can see the format. This is called reconciliation between the net profit before tax and cash generated from operations. This is the note for what? This is the note for cash generated from operations, but they usually call it reconciliation between net profit before tax and cash generated from operations. What does the note require? Number 1, it requires a net profit before tax. That's what the note requires. Net profit before tax. So going to our information, this is the information they gave us. Net profit before tax, how much is it? 1,500,000 rand. So this is the 1,500,000 rand that I will take and record it here. Okay. This is the 1,500,000 rands that I will take and record it here because it is part of what? The net profit before tax. Secondly, we have income tax. Okay, what does the note require? It requires adjustments in respect of depreciation. Why are we adjusting the depreciation? Because from this profit before tax of 1.5 million, net depreciation is included in that amount. So we have to exclude it. When we say adjustment in respect of depreciation, it means I want to exclude depreciation from this amount. We must not forget that depreciation was subtracted from the profit Now, if I want to remove that or to cancel that transaction, I need to add it back. So I will record my depreciation as positive because I have to add it back. So going to my information, they're saying here, the following expenses appeared in the income statement. As you can see here, depreciation on equipment with 20,000, depreciation on vehicles with 36,000, and then with interest on loan. So these are the two. 26 plus 36,000, sorry, 20,000 plus 36,000, they need to be here. 20,000 plus 36,000. So this is what? This is going to be a depreciation. And then if we add the two, how much we're getting? 56,000 rands. I think it's going to be 56,000 rands. The total depreciation that will be recorded. I'm going to record it as positive here because I'm trying to remove it from that profit, or I'm canceling it back. Initially, it was subtracted here. Now I'm adding back. I'm adding it back. It was subtracted from the profit, right? It was separated from the profit. Now what do? I'm adding it back, add it back. Why? Depreciation is a non-cash item. So the reason why we're canceling it, we need to exclude from the profit that is sitting in the income statement. Remember there, there is an income that is a non-cash item that we include there. We have expenses that are non-cash items that we exclude there. Then we need to cancel those non-cash items such as like depreciation, bad debt, trading stock deficits. Those things are non-cash items, right? So there was no cash movement in all of those things. So we need to remove them. That's why I'm adding a depreciation back, because it is one of the non-cash item that was deducted in the net profit before tax in the income statement, which was correct. But for the purpose of the cash flow statement, we don't have to exclude that. Interest expense. Remove interest expense. It was separated here, but what do we need to do now? I need to add it back. How much is the interest on loan? There is it here, 14,400 rands. Why am I adding back interest on loan? Anyone who would like to try on this one? Why am I adding it back? Is the interest expense a non-cash item like depreciation?
Don't you do it in a different, don't you add it in a different note or something?
The interest expense, no, I have to add it here. It's part of this note.
Oh, I'm not
I have to
sure.
add it. Okay, no problem. You know the reason why we're adding it back. Interest expense, we add it back in this note. The reason for that, not because it is a non-cash item. Interest is a cash item because we pay it, right? If we incur interest on loan, we're going to pay that interest to the bank or whichever institution that we're owing. It's unlike depreciation, but the reason we're canceling it from the net profit before tax is because on the cash flow statement, interest has its own line. So we're trying to remove it because cash generated from operations, it's that note will come here. But when we exclude interest there, we're going to record it separately on this on the face of the cash flow statement. That's why I'm going to say add back 14,400 here, and then that 14,400 will be subtracted here. On the face of the cash flow statement, it has its own line. So the interest paid, right? So because of that,
So your mic is cutting out.
oh, sorry guys. Hello, can you hear me now?
Yeah.
I'm sorry, I think I'm having a network glitch here. I'm sorry about that. Can I check something? Hello guys, can you hear me now?
Yeah.
Okay, I'm sorry about that. I hope this thing won't affect us now. Okay. I was saying that the reason why we excluding it here, I'm canceling it when I'm adding it back. It's because it has its own line item. It's not because of being a non-cash item. No, it is a cash item because we do pay the interest. Just that we have to remove it from the profit before tax and then put it on its own line. That's what happens. That is the reason why interest on loan I have to consider it the same way as depreciation. So all these three things I've already excluded them. From this note, as you guys can see there. Okay, if we carry on with the note, going back to our information, they didn't tell us about anything else that was on the income statement that should be adjusted there. So which means now I can be able to get what? My operating profit before changes in working capital from the note. I'm going to have what? 1.5 million plus 56,000 plus 14,400. That is going to be 1,570,400 rands. Okay. In that scenario, now I need to move on. What does the note say? It says cash effect of changes in working capital, right? Cash effect of changes in working capital. It has increase or decrease in inventory, increase or decrease in receivables, increase or decrease in payables. So now I need to go and check these things, whether my inventory has increased or decreased, and whether it gives me an inflow or an outflow of cash. Let's go and check. Let's go and check. So this information is going to be in the balance sheet now, because remember guys, what did we say before? We're dealing with cash flow from operating activities here. We said when we're getting cash flow from operating activities, we're going to focus statement. You could see there that I was dealing with interest just now. I was dealing with depreciation just now. And we took the net profit before tax. You remember that. And then now we need to go to the current assets section of the balance sheet. That's what we need to go and check now to see if we can be able to look at that. And we're also going to look at the current liability section of the balance sheet, because for now we're still working on the cash flow from operating activities, which is the first note of cash generated from operations. Now this is increase or decrease in inventory, which is part of current assets. So what do I need to do now? I need to go to my balance sheet and look for inventory. Summary of from the balance sheet as at 28 February 2014, 28 February 2013. If you look at this information, let's go and see. We said there we have inventories. There is inventories here. There is inventories here. Looking at this, we need to check whether the movement in the inventory will give us a cash inflow or cash outflow. Okay, looking at the note, it says increase or decrease in inventory. Now, first, I need to remove one between the two. Between this increase or decrease, I need to remove one because it's either the inventory will increase or it will decrease. Let's go and check. From the previous year, inventory was 59,700 rands from the previous year. And then in the current year, it is 74,000 rands. Did the inventory increase or it decreased? Is this an increase or a decrease?
Increase.
It is an increase, yes, very good. It is an increase. So when the inventory is increasing, so which means I need to remove decrease here, which means we had an increase in inventory. From how much? If I look at the amounts here, it moved from 59,700 to 74,000. So it moved from 59,700 to 74,000. Okay, to 74,000. So when the inventory is increasing, is that an inflow or an outflow? What do we get from there? Is it an inflow of cash or is it an outflow of cash when the inventory is increasing?
No.
Come again?
Outflow.
Outflow. Why are we saying it's an outflow?
Because you're buying more cash. I mean, you're buying more inventory, which means more cash.
Exactly, very good on that. If the inventory is increasing, it means we purchased more inventory, which means there will be a cash outflow. We're going to use the cash that we have to buy that inventory. So when the inventory is increasing, it's an outflow of cash, right? Increase in inventory. It means that is an outflow of cash, right? Decrease in inventory. It is an inflow of cash, right? It means we sold inventory and we're receiving money. We outflow of cash, which means we purchased inventory using money. Here, we sold inventory using money. That's why it decreased. So in this scenario, it will be an outflow of how much? 59,700 minus 74,000. How much we're getting?
14,300.
14,300, which is going to be an outflow. Okay. Are you following this one, Simang, on your side?
Yes, I'm following.
Okay, please, I want you to pay attention to this one because I want you to understand when we're saying inventory is increasing, we're saying it is an outflow of cash. It's because I went to buy inventory. So when you're buying inventory, going to use cash, obviously there will be a movement of cash there going out. But if there is a decrease in inventory, that is going to be an inflow of cash. It means you sold inventory and you received cash. That's why inventory decreased. Now, going to receivables, let's go and check. Going to trade and other receivables, there is it there. Okay, what is happening here? It moved from 92,000 in the previous year to 68,500 in the current year. Trade and other receivables, did they increase or decrease? Is this an increase or is this a decrease?
Decrease.
It is a decrease, exactly. It moved from 92,000 to 68,500, right? So now I need to say there was a decrease in receivables, right? There was a decrease in receivables from 92,000 to 68,500, okay? 92,000 to 68,500, okay? It moved from 92,000 to 68,500. There was a decrease. So if there was a decrease in inventory, in receivables, if there was a decrease in receivables, is that an inflow or an outflow?
Outflow.
Why are we saying it is an outflow?
Because you're receiving less money.
Receiving less money. Receiving less money, it is an outflow because we're receiving less money. Okay. You're receiving less money, but it's an outflow, but you're receiving something, Kinelo. Does it make sense? You're receiving money, but it's less. But
I don't know.
it. You're receiving it, but it's less, even though it's less, but you're still receiving it. How is it an outflow? I'm just saying, what I'm saying is based on what you said to me. You're saying we're receiving less money. How is it an outflow when you're receiving something?
I don't know. Maybe like
proper reason for this one.
Is it like?
Okay, I'll make an example for this one. Last year, I had 5 people owing me. We're saying there's a decrease in receivables. Okay, I had 10 people owing me. Right? 10 people owing me last year. Last year or previous year. Now I have 5 people owing me. You see, they decreased, all right? What happened about the 5? What happened about the 5? Yes, come.
They paid.
They paid. So when they paid me, did I like receive money, or money went out from me, or I received money came to me? What
You
happened?
received money.
You received money. So does that mean it's an inflow or it's an outflow of cash?
Inflow.
Exactly, it is an inflow. Very good on that. So we're going to have what? An inflow, because when there's a decrease in receivables, it means my debtor has paid me money. My debtor has paid me. If 10 people were owing me last year, now 5 are owing me, which means the other 5 paid what they were owing me. That's why there's a decrease in receivable, which means it is an inflow of cash, right? It's an inflow of cash. It is an inflow of cash. But now when people that are owing me money, they increase. 10 people were owing me last year. Now 15 people are owing me, which means more people, I borrowed more money, or maybe I sold on credit, right? To more people, to more debtors. More people are owing me. It's like I borrowed money to people that are more than, or maybe extra people came to borrow money. There was an outflow of cash, right? That is an outflow of cash if more people are owing me. So in this scenario, it is going to be, this is a decrease in receivable. So it means it is an inflow of cash. Of how much then? 92 minus 68, how much we getting?
$23,500.
We're getting 23,500 rand. Okay, 23,500 rand. Okay, we're saying this is an inflow of cash. We're saying this is an inflow of cash. Okay, let's talk about payables now. Let's talk about payables now. Where is trade and other payables? There is it there. Trade and other payable. They said C note number 3. The reason why they're saying C note number 3 is because we said we need to remove here. There is amounts that we need to remove. These two, they should be removed, because SARS income tax, we're gonna use it when we're calculating tax paid. Shareholders for dividends, we're gonna use it when we're calculating dividends paid. So which means those will be calculated separately. So it means instead of using this total, because remember this 693,100 is this one. 690,100, there is it there, and 582,300, it is here. So which means now my trade and other payables, instead of using these totals, I'm gonna use 352 plus 5,000. So which means now this is going to be 357,000 in the previous year, right? Which means it was 357 in the previous year. That is my trade and other payables in the previous year. And then in the current year, it's going to be how much? It's going to be 396,500. 396,000, and then plus the 7,500. So which means now how much we're going to have in the current year? 396 plus the 7,500. We're getting the 403,500 in total. So I'm going to 403,500. So you need to work out the new totals, right? You need to work out the new totals that will exclude. You need to work out the new totals that will exclude SARS income tax and shareholders for dividends. We must always be careful of that. Even if it's trade and other receivables, sometimes trade and other receivables will have SARS income tax sometimes. So you must always exclude it, because these two, we calculate them separately. So now things are changing here. 2023, 2013. Trade and other receivable were 357,000. Then now 2014, it is now 403,500. So what does that mean? It increased. We can see here, it moved from 357,000 to 403,500. So there was an increase in payables. There was an increase in payables. So what does that mean? Is this an inflow or an outflow?
Inflow.
Inflow, why we're saying inflow?
Because you're paying less. You're paying less back to the creditors.
Because we're paying less back to the creditors.
Yeah.
No, I don't want that one, Kinelwe. I don't want that explanation. I don't want that explanation. We're paying less. No, that's not the correct reason. You are correct by saying it is an inflow. You said it's an inflow, right?
Mm-hmm.
You are correct by saying it is an inflow, but your reasoning is not the right one. Your reasoning is not the right one. Okay, let's create a scenario again. Yeah? Because my payables have increased, right? Which means now I was owing, I'm the one who's owing now. I was owing 10 people, right? I was owing 10 people last year. Now I'm owing 15 people. Now I'm owing 15 people. I was owing 10, now I'm owing 15. What happened? Why am I owing more? Why am I owing more? Why am I owing more? Or maybe let's say, Kinelwe, I was owing you 100 Rand yesterday or last year. Now I'm owing you 150. What happened?
I took out more money or interest.
It is an interest. Okay, you're saying it's an interest, right? So which means now I'm owing more because of interest. That's what you're saying, yeah?
Yeah.
It makes sense what you're saying. It makes sense, but not really the case. You see how I want us to treat this. It could be that I'm owing more because of an interest. Yes, it's a valid reason, but let's take as if like let's take out the interest, right? I was owing you 100 Rand last year. Now I'm owing you 50 Rand, which means you borrowed me another 50, or maybe you sold on credit. Remember, payables and receivables, they're not about borrowing money actually. It's about selling on credit or it's about buying on credit, right? So because this is trade and other payables actually. This is trade and other payables. So which means now I was owing 10 creditors. Now I'm owing 15 creditors, which means now I bought more stock on credit, right? Or I received something without paying for it. So which means now that is going to be an inflow as a result of that, but I'm going to treat it as if those creditors, they gave me money because that stock that they're giving me, I'm going to convert it into cash. So if they're giving me more stock, which means 10 people who gave me stock last year, now 15 people gave me stock this year, which means now the stock that I got without paying for it, it has increased, but now I'm going to convert that stock into cash. That is going to end up going to be an inflow of cash. So if creditors are increasing, which means now it's like I borrowed more money. It's like I borrowed more money, even though they gave me the stock, but I'm going to convert that stock into cash. So it's the same scenario as if I borrowed more money from them as compared to previous year, and then it's an inflow of cash in that scenario. So this increase in payables, it is going to be an inflow of cash because it's like I received more cash from my creditors or I borrowed more money. but in a form of trading stock. They gave me stock, then I'll convert that stock into cash. That is an inflow of cash for me. But did I pay anything to them? No.
No.
Exactly. So it's going to be an inflow of cash. Then for how much? Get 357 minus 43.
$46,000.
46,500 rands, 43,500. 357 minus 43,500. It's 46,500 rands actually, no? 46,500. So we said this is an inflow of cash. This is very important, guys. This is very important. I want you to understand this thing. I want you to play with this. Change, make it increase, make it decrease, make it increase in receivable, decrease in receivables. That's why here I'm making these notes, right? So that you can be able to understand this thing. Okay, so we said here there was an increase in payables. So increase in payables, I'm saying that is an inflow of cash, right? Decrease in payables, that is an outflow of cash. Don't forget this thing, please. Please, let's not forget this. Very important. It is very, very important. So I don't want us to forget it. Ne? Okay. Then the cash effect of changes in working capital. So it's going to be these three. So I'm going to add these three and see what I'm going to get in total. Okay, I have 55,700 rands, 55,700 rands in total. And then my cash generated from operations is going to be 1,626,100 rands. Can we see here? It's going to be 1,626,100 rands. So that is the amount that I'll take and record it here. It's going to be, oh, sorry, am I doing now? It's going to be 1,626,100 rands. 1,626,100 rands. So that is the amount that is going to sit in my. That is the amount that is going to sit in my cash generated from operations. Okay. And then next.
So are you talking?
Hey, abantu abazwakali.
Sorry, guys. I think the network is bad this side today. The weather is bad. I'm so sorry. I keep on disappearing. I'm sorry about that. Can you hear me now?
Yeah, so
Okay, I'm sorry about that. It's just the network that is very bad today this side. Okay, but I'm back now. We're going to carry on now to the next part of my, the next one is our cash and cash equivalents, right? The next note is our cash and cash equivalents. So we're done with the first note. We're done with these first notes. Now we need to do the cash and cash equivalents note and see if we can do it. Cash and cash equivalents note, very easy, this one. That's why I'm saying it's not important. There's even no need for us to do this note. Okay. Let's see. Cash and cash, you see the format here. We're having bank, we have petty cash, and then we have cash float. These are the possible amounts that you can get from the trial balance. Then you're going to put your amounts for 2013, you're going to put your amounts for 2014, and then you look at the change and decide whether it's an inflow or an outflow. So let's carry on and see. let's get on and see. Let's go and see. There is bank here. We have bank there. How much? We have 165,000 and 110. So in the previous year, it's 110,000, and then in the current year is 165. So in 110,000, and then we have 165,000 in the current financial year. 110,000 in the previous year, 165,000 in the current year. Okay. Then what else we have? We have petty cash of 5,000 and 6,000. We have petty cash of 5,000 and we have 6,000 in the current year. Okay. And then to have the cash float, we don't have cash float here. So our cash float is going to be 0 and 0 this side. Okay. Now we're asking ourselves a question. Okay. In the previous year, I have 110,000 in my bank account. Then in the current year, I have 165,000. Right? I had 110 in the previous year. In the current year, I have 165. So how much is the change here? $165 minus 110. How much is the difference that we have?
55,000.
Am I the only one who can't hear anything?
I can't show him.
Hello guys, can you hear me?
Yeah.
No, I'm so sorry, man. Today I don't know what's going on with my network. I honestly don't know what's happening. It keeps on like kicking me out and I don't know what is happening. Okay, I was asking guys, it's fine, we'll close our session soon, shortly. I was asking what is the change that we have for the bank? How
55,000.
much? We're having 55,000 rand, okay. Thank you on that. We're having 55,000 rand, okay. So in these 55,000 rands that we have, in these 55,000 rands that we have, is this an inflow or an outflow? Judging from the
Inflow.
movement, it is going to be an inflow. Very good, because our cash has increased. It was 110 and then it increased to 165. So which means there was an inflow of cash of 55,000. So this is going to be positive. Let's talk about petty cash. It was 5,000, now it is 6,000. So obviously there is 1,000 change. Is this an inflow or an outflow?
Outflow.
Why are we saying it is an outflow?
Because you're allocating more to petty cash in 2014 than in 2013.
We allocated.
Actually, I'm not too sure, but yeah.
Okay, you see what happens, né? You see what happens. An increase in petty cash is still an inflow, all right? It is still an inflow. of cash because we had 5,000 sitting for petty cash this year, and then we have 6,000 as a closing in the current. So which means we increased our petty cash with 1,000. It is still an inflow of cash. It is not really an outflow. Had I had maybe 2,000 here in the current, it was 5,000. Now I have 2,000, which means I used petty cash, which means it went out. But instead of using it, I filled it up. So I still have a petty cash of how much? Of 1,000. So, okay. Then now the difference between the two, moving from 115,000 to 171,000, what can I say here? Obviously, there was an increase. There was an increase of how much? There was an increase of the difference between the two, which is 56,000. And then even if I do it vertically, it is going to be 56,000. Okay. So which means now my net change in cash and cash equivalents, right? So my net change in cash and cash equivalents here, cash and cash equivalents at the beginning of the year, how much do I have? Cash and cash equivalent at the beginning of the year, it is going to be 115,000 at the beginning of the year because this is what I have. And then at the end, it is 171,000. At the end of the year, it is going to be 171,000. That is the one that we calculated here. And then the net change in cash and cash equivalents, it is going to be the 56,000. So which means now this part of cash flow, it is complete, right? It is complete. Just from note number 2, you can see how these notes are helping us. Then when it comes to dividends paid, in how we calculating it, in how we're calculating the dividends paid, what happens when the dividends paid? It says final dividends of the previous financial year. We talk about the final dividends of the previous financial year plus interim dividends of the current financial year. So sometimes it happens that you know the interim dividends for the current financial year. Sometimes it happens that you don't know the interim dividends. But looking at the information that we have, we must know very well that okay, now we're coming to this information notes number 2. We are talking about dividends now. I will just go straight to let me just go straight to my trial balance, to my balance sheet, so that we can see what we're talking about. Just gonna remove this information. Now we're trying to calculate dividends paid, right? We're trying to calculate dividends paid, which means that is the amount that will come here in our cash flow statements. Dividends that were paid. And also we have notes number 3 that is going to help us. So we have 2 options here. We can calculate it by this method, or we can calculate it by this method. These are the notes that we can use to calculate. Okay, so that's what we need to check. Okay. Let's go and see then. Let's go to our information. So trade and other payables, note number 3. This information is going to be here in note number 3. This shows us for dividends here. This shows us for dividends. This is a shows us for dividends at the beginning, shows us for dividends at the end. And then on our distributable reserves, we have dividends that is sitting there, right? So this is the information that we need to use for us to, this is the information that we need to use for us to get the dividends that were paid or dividends that were declared. Okay, but now looking at this note, it says final dividends of the previous financial year. If we're using this one, final dividends of the previous financial year. How much is my final dividends of the previous financial year? Which means final dividends obviously will be this 188,000, because this is the final dividends of the previous financial year. It will sit as shoulders for dividends. So I'm going to have 188,000 rand as my final dividends. of the previous financial year, I'm going to have 188,000 plus interim dividends of the current financial year. How much is my interim dividends for the current financial year? If I go back to the information, how am I going to get my my interim dividends? Because they're saying here plus interim dividends of the current financial year. How am I going to get my interim dividends? How am I going to get my interim dividends? How am I going to get my interim dividends? Remember, guys, I want to, yes.
I wanted to ask if you're going to subtract the 188 from the retained income from the dividends. No, you're going to you're going to subtract 240 from 440,000.
Yes, very good on that, because you know why. The reason why you're saying that is because in these dividends, we have interim plus final here. And we know very well that final will always be the same as the shoulders for dividends, which is the closing balance. So you're 100% correct on that. So for us to get our interim dividends, we're going to say 440,000 minus 240,000. And then how much we're going to get? 440,000 minus 240,000. And then how much we're going to get? It's not going to be 200,000. Yes, 200,000 rands. That is going to be our. 200,000 is going to be our interim dividends. Then I'm getting the total of dividends paid in the current year, right? Dividends paid in the current year. And if we go to our notes, I think I did indicate something like this at the end, right? Dividends paid, that is shoulders for dividends, opening balance, and the current year interim dividends. Shoulders for dividends, opening balance, and the current year interim dividends. Is this not what we did here? There is final dividends of the previous year. That is the shoulders for dividends at the beginning of the year. That's what it says here. Shoulders for dividends at the opening balance is the same as final dividends of the previous financial year, right? Which is this 188,000 plus interim dividends of the current financial year. That's exactly what we used. 188,000 plus the interim, which is these are the two amounts. Then we're getting the 388,000 rands. But there's another method here where it says dividends for the financial year as reflected in the financial statements. The total dividends for the financial year as reflected in the financial statements. So that's what they're saying here, dividends for the financial year. Now we're talking about the total, which is interim plus final. That is the 440,000 rands. So I'm going to take my 440,000 rands and I put it here. And then I put it here. And then the second part, what does it say? The second part, it says balance in the shoulders for dividends at the beginning of the year. That I need to add that. Shoulders for dividends at the beginning of the year, that is 188,000 rands. So I need to say plus 188,000 rands. And then balance in the shoulders for dividends at the beginning of the year. Sorry, this should be at the end. Can't be at the beginning of the year. It should be at the end of the year. Balance in the shoulders for dividends at the end of the year. And then how much you're going to get there at the end of the year. We're having the 240,000 rands, right? We're having the 240,000 rands. And this is going to be separated. This is going to be separated. We actually have to say less here to show that we are subtracting this one. And then the difference, if I'm adding all these ones, I still need to get the same amount, which is going to be the dividends paid. Can you guys see the two methods that you can get your dividends paid using following the two methods? But what are you usually say, on my side, it's very good that for you to prepare the T account. I always encourage that because this note is actually a T account written in the form of a note, right? So it makes things easy when you prepare your T account, like your general ledger account, where you can be able to calculate your dividends paid. So the general ledger account that you need to prepare is for shareholders for dividends, right? Shareholders for dividends. I always encourage this one. So we're going to have your debit here, and then we're going to have your credit. So which means now, obviously, you're going to have your balance brought down on your debit side, which is how much. We're going to have our balance brought down, which is going to be how much? 188,000. So I'm going to have my 188,000 here is my opening balance, right? 188,000 as my opening balance. Okay. Then now this side I am going to have what? My balance carried down, which is going to be how much? That is going to be my closing, which is 240,000. It's going to be the 240,000 rands. Okay. And then I'm going to have a total here, and I'm going to have what? A total here. Then this side, I'm going to have what? Dividends. Dividends on ordinary shares, right? Dividends on ordinary shares. Dividends on ordinary shares. So how much I'm going to have? The total of dividends on ordinary shares, that is going to be 440,000. I'm going to record my 440,000 rands this side, right? And then I'm getting my total of my debit and credit side. So obviously the sides have to balance both of them. So we're getting 628, and then I'm going to have what here? I'm going to have my bank. I'm going to have my bank here, which is going to be this one minus this. Then I'm getting what? I'm getting my dividends. That was paid. Can you see, Uguti? This is like a T account in a form of a note. They wrote it in a form of a note, but it's supposed to be, it is actually a general ledger account. Same thing. I always prefer a general ledger account instead of a note, because now it means you have to it's network.
So we can't show you.
I disappeared again, guys. I'm sorry. I think I'm just gonna end the class here for today because my network is giving me a problem. I honestly don't understand what's going on. It shows it's connected on my laptop, but I just disappear. I don't know, because now I can hear what Vincent is on my side. I'm sorry, guys, but I was emphasizing this is a T account in a form of a note. So I want you guys to learn this T account. When you're doing the workings on the test, I just want you to do a quick T account. But sometimes there will be no need for this T account. It maybe that's when you're going to be using this method where you just add the two amounts, your interim dividends plus the opening shareholders for dividends, because this 188 is the opening balance, as you can see here, plus the interim. Then you know that you are done, which is the same thing for the tax, which means now for dividends paid, we've already calculated it with 388,000 rands. So I can go and record my 388,000 rand here as what is my dividends paid. We can go and record the 388,000 as my dividends paid. And then when it comes for income tax paid, which is SARS income tax, I'm doing this. This is the last one I'm doing for now, and then I'm going to close our session, guys. For tax paid, again, we're going to come here. We have SARS income tax here, which is a liability which is sitting under trade and other payables. I always encourage you to prepare a T account again here. So that is going to help us in terms of like that is going to help us. Like, I just want us to do the T account again when it comes to calculating the SARS income tax. Okay, but also they want us to show the notes here for income tax. So they're saying here income tax for the financial year is reflected in the financial statements. Where is that? Income tax is reflected in the financial statements. There is income tax here, 450,000 rands. So we need to go and record it here, 450,000 rands. This is the income tax they're talking about here, right? This is the income tax they're talking about here. Balance in SARS income tax at the beginning of the year. How much is SARS income tax at the beginning of the year? That we have 37,300 rands. That is going to be my opening balance, 37,300 rands. And then balance in SARS income tax at the end of the year, how much we have? 49,600 rands. So that is going to be a minus again. So we have to say less, right? We have to say less, this one. Minus, go minus 49,600. Okay. The opening balance will be positive, but closing has to be negative. And then if you calculate these ones, they're going to give us how much? 437,700 rands. Okay. I also want you guys to do a T account for this one as well. I want you to do a T account for this one, which is going to help us in terms of like understanding. Okay. SARS income tax. That's what I want you to do. I want you to be able to calculate it using like the T account. So you're going to have your opening balance, and then you're going to have like your balance carried down. Okay. Balance carried down, which is going to be how much is our balance brought down? 37,300. I'm going to have it here, 37,300, and then here I'm going to have what tax expense, right? I'm going to have income tax actually in my credit side, income tax, and then here balance carried down. How much is it? 49,600. So I'm going to have what 49,600 this side, and then income tax. Their income tax is the same that we have. It's going to be 450,000. Is the same as that one. It's actually this 450. How much did we have there? Yes, 450,000. That is our income tax. And then I'm going to add these two and get the total. And then this one should be equal to this one. And then here, I'm going to get the difference between the two, which is going to be 437,300. I have bank here. So this is the method I want us to follow when we're dealing with SARS income tax instead of a note, because the note will always confuse us, guys. It's not important also. What is important is the calculation, because you'll find out that there's an opening balance of SARS income tax that is part of payables, but the closing balance is part of receivables. So that will be a trick situation that I want us to be able to deal with, right? There will be a situation where you're going to find out that everything is on one side. Everything is on one side. Let me just show that one to you quickly. There will be a situation where you will find out that you have your opening balance, you have your closing balance in the same side. You can see here, you have there's a situation where we're going to have something like this. You see, opening balance this side, income tax this side, closing balance this side. And then you're getting your total. And then here, this side, you only have bank. There will be a situation like this, or everything that you see is on a debit side, and then the other one is on a credit side. there will be something like that, right? It's possible. So I want us to use T account, because when you come across to a situation like this, it will confuse you when you come in here in a note. Either way, notes are not important, as I said to you. The important note that I want you to know is this first note that we dealt with. Cash generated from operations, this one, very important that you understand this note. I want you to practice it, but all other notes is for your understanding. This is the reason why I want us to do them. Before this network kick me out again, guys, I will stop. I will stop the class here. I will meet with you guys again on Monday. We're going to finish this question, and then after that, I think we can go to the question papers. But any questions? Any questions on your side, Snaga?
No, I'm good.
Okay, Kimele, on your side?
No.
Okay, guys, no problem. What I will do, I'll email the spreadsheet to you, or email the question. You can carry on with the question, complete it. But on Monday, we're gonna do it together again and finish everything. And then after that, from Wednesday, we can work on the question papers moving forward up until we feel that we are comfortable, and then we can move on to the next topic after that. Thank you guys for your time. I wish you a lovely evening and a good weekend. I'll see you on Monday. Goodbye.